Topic 13. Strategic investment decisions. Strategic investment decisions refer to the process of selecting, evaluating, prioritizing, and managing long-term investments that shape an organization's future competitive position, growth trajectory, and enterprise value. Unlike routine operational expenditures, strategic investments involve significant financial commitments with long-term implications for business capabilities, innovation, digital transformation, market expansion, acquisitions, sustainability initiatives, and organizational resilience. For modern chief financial officers, CFOs, strategic investment decisions represent one of the most important responsibilities because effective capital allocation directly influences shareholder value creation and long-term corporate success. Leading executive CFO programs emphasize that finance leaders have evolved from financial controllers into strategic capital allocators who integrate financial analysis with business strategy, risk management, market intelligence, and digital transformation objectives. Rather than simply approving budgets, CFOs actively shape enterprise strategy by identifying investments that create sustainable competitive advantages while ensuring disciplined financial governance and optimal use of organizational resources. Strategic investment decisions begin with strategic alignment. Every major investment should support the organization's long-term mission, competitive positioning, and business transformation objectives. Whether investing in new manufacturing facilities, artificial intelligence platforms, digital infrastructure, acquisitions, sustainability initiatives, or geographic expansion, organizations must ensure that capital deployment contributes directly to strategic priorities rather than isolated operational improvements. The investment evaluation process typically starts with opportunity identification and strategic assessment. Management identifies investment alternatives based on customer needs, technological developments, competitive dynamics, regulatory changes, market intelligence, and macroeconomic trends. Each opportunity is evaluated not only for financial returns, but also for its contribution to innovation capability, digital maturity, customer experience, operational resilience, and long-term market positioning. Financial analysis remains a cornerstone of strategic investment decision-making. CFOs apply quantitative techniques such as net present value (NPV), internal rate of return (IRR), payback period, profitability index (PI), economic value added (EVA), and return on invested capital (ROIC) to assess investment attractiveness. NPV remains the preferred method because it measures the increase in enterprise value generated by an investment after considering the time value of money. However, leading organizations increasingly complement these traditional methods with strategic and non-financial considerations that reflect long-term competitive advantage. Modern strategic investments often involve significant uncertainty due to technological disruption, changing customer preferences, geopolitical developments, and regulatory complexity. Consequently, organizations increasingly employ scenario analysis, sensitivity analysis, Monte Carlo simulation, and real options analysis to evaluate multiple possible future outcomes. Rather than relying on a single forecast, finance leaders assess how investment performance changes under varying assumptions regarding demand growth, inflation, interest rates, exchange rates, technology adoption, or competitive responses. This approach improves decision quality while reducing strategic risk. Digital transformation has fundamentally reshaped strategic investment priorities. Organizations now allocate substantial capital toward artificial intelligence, cloud computing, cybersecurity, automation, advanced analytics, digital platforms, and enterprise software systems. Unlike traditional capital investments focused on physical assets, digital investments often generate intangible benefits such as improved customer experience, enhanced decision-making capabilities, operational agility, and data-driven innovation. CFOs therefore evaluate digital initiatives using both financial metrics and strategic performance indicators, such as customer lifetime value, digital adoption rates, productivity improvements, and innovation capacity. Strategic investment decisions also play a central role in corporate portfolio management. Organizations continuously balance investments across mature businesses, emerging technologies, innovation initiatives, acquisitions, sustainability programs, and international expansion opportunities. Dynamic capital allocation enables leadership teams to redirect resources toward higher growth opportunities while reducing exposure to declining markets or obsolete technologies. Finance leaders support this process by comparing investment alternatives based on risk-adjusted returns and strategic importance. Enterprise risk management is closely integrated with strategic investment decisions. Large capital projects expose organizations to execution risks, technological uncertainty, supply chain disruptions, regulatory changes, geopolitical instability, financing constraints, and market volatility. CFOs evaluate these risks through comprehensive due diligence, stress testing, contingency planning, and portfolio diversification strategies that preserve financial flexibility while supporting strategic growth. Environmental, social, and governance (ESG) considerations have also become increasingly important in strategic investment decisions. Investors, regulators, and stakeholders expect organizations to incorporate sustainability, climate resilience, responsible governance, and social impact into long-term capital allocation decisions. Investments in renewable energy, circular economy initiatives, carbon reduction technologies, workforce development, and sustainable supply chains increasingly contribute to enterprise value while supporting corporate responsibility objectives. Effective governance ensures that strategic investments are continuously monitored after implementation. Post-investment reviews compare actual financial and operational performance against original assumptions, enabling organizations to improve future investment decisions while enhancing accountability and organizational learning. Key performance indicators, milestone tracking, and executive oversight ensure investments remain aligned with strategic objectives throughout their life cycle. The Global Competency Framework identifies capital expenditure and investment evaluation, business planning, strategy, business models, planning and forecasting, and corporate finance as core competencies for executive finance professionals. CFOs are expected to evaluate complex investments, translate corporate strategy into capital allocation priorities, anticipate future organizational needs, and provide strategic financial guidance that supports sustainable value creation and long-term competitive advantage. In today's rapidly changing global economy, strategic investment decisions have become a fundamental leadership capability that integrates finance, strategy, innovation, digital transformation, and risk management. Organizations that systematically evaluate investments through disciplined financial analysis, strategic alignment, scenario planning, and dynamic capital allocation are better positioned to achieve sustainable growth, organizational resilience, and long-term enterprise value creation.